The U.S. jobs report is always an anticipated event, though it doesn't quite pack the same punch as it once did. This in large part credited to the fact that the data hasn't given the market anything new to chew on for many, many months. The story has been the same here. Ultra-accommodative Fed policy post-2008 crisis has been responsible for taking the headline components of this report to levels that already easily justify higher rates. It's been this way for a long time. NFPs are tracking around 180K this year, while the unemployment rate sits all the way down at around 3.8%, the lowest is in about 50 years. So any one-offs on one way or the other aren't likely to have any sustained impact. At the same time, hourly earnings, which are used by many as an inflation indicator, have been subdued overall, which has left the Fed scratching its head, but also relieved that it doesn't need to worry about raising rates and cooling off the U.S. economy and global economy by extension, with inflation still well in check. Now, we have seen hourly earnings slowly moving up, and this is where we do believe the X factor in the data continues to be. If we see this data deviate from expectation, it is a piece of data that will have the ability to jolt the market. If we look at this component for today's report, the market is looking for hourly earnings to tick up both year over year and month over month. And as things have gone, if we see this data exceed expectation, it would likely inspire dollar demand and selling in the stock market, as it does put more pressure on the Fed to be needing to raise rates. If, however, earnings come in softer, the dollar could come under pressure while equities could be looking back up to extend their record run. But we would also say that it's worth noting there has been clear evidence of NFPs cooling off despite still trending at healthy levels. We've come from NFPs that averaged well over 200K in 2018 to NFPs averaging around 180K in 2019 thus far. This would certainly make for a bearish case for stocks, especially if we start to see a more disturbing trend of falling NFPs and rising inflation. Hourly earnings are expected to tick up to 3.3% year over year from 3.2% previous, while the monthly component is expected to rise to 0.3% from 0.1% previous. NFPs are forecast to come in around the 2019 average at 185K, which would be a tad softer than the 196K previous. The unemployment rate is expected to hold steady at 3.8%. That's all for now.